Good morning and welcome to this week's Market Thinkers discussion. I'm Jamie Nemsis and I'm joined by Drew Meredith, my co-host and business partner. And our guest today is Joseph Lai from Platinum Asset Management. Welcome, Drew. Welcome, Joe.
Thanks, Jamie.
Thank you.
First, the Market Thinkers series. Every week, Drew and I bring these insights, or we're trying to bring insights from leaders, thinkers, and investment experts, essentially bringing you, the investor, closer to the coalface. It's very much that's my phone. very much the coalface that Drew and I and our team see every day. You can see previous versions on our website. We've done 7 or 8 of these in the past 2 months. It's also available on our YouTube channel and available through Apple Podcast. For the listeners that don't know Drew and I run Wattle Partners. Wattle Partners is a wealth management group that was actually founded back in 1973 by Austin Donnelly. Austin Donnelly was one of the first fee-for-service independent advisors in Australia, and he was really an advocate for investor rights, also founding the Australian Investors Association. Drew and I run very much the same firm, independent, fee-for-service or fee only. We essentially manage portfolios. We have clients from big and small, from family trusts to individuals. So today, this session, we're welcoming Joe from Platinum Asset Management. Joe is the portfolio manager of the Platinum Asia Fund, an active Asian equity strategy. We first started using Platinum Asset Management in 1995 when it was first founded, and we started using the Platinum Asia Fund in portfolios from when it was founded in 2003. So we've got a long association with Platinum Asset Management. In fact, I don't think there's been a time that our core portfolio hasn't had Platinum in it. So today's title of this session is "The Future is East," and it's all about why Asia will be the growth driver of our global economy. Anyone that has heard how we build portfolios, especially global portfolios, will know that we've got a natural tilt to Asia. Today's session will be like every other session. Drew will introduce why Platinum Asia is in our core portfolio and the role that it plays. And then I'll ask Joe 10 quick fire questions, and then we'll get on to his fund and talk about what's in there and why it's in there. And then we'll have a whole series of questions. Of course, there's a number of people joining us. This is not just a podcast, but it's also live. So if you have any questions at all for Joe, I'm sure he's more than happy to answer them through the session. So Drew, do you want to just introduce Platinum Asia and why it's in our model portfolio?
Perfect. Thanks, Jamie. Welcome, Joe. As we've kind of discussed in previous sessions, we view global equities in these kind of buckets, one being large caps, one being small caps, and then specific tilts to regions, countries, or key themes. We've found over the long term that the best returns come from identifying the most powerful themes in the world. That can be demographic trends, technological trends, or environmental. Asia, to us, kind of hits on all 3 at the moment, which I'm sure Joe will go into. But the big one there for us is the Asian middle class, which is, according to most reports, the fastest growing consumer market in the world. I know the numbers are huge and a lot of attention gets paid to things like luxury goods and wine with Treasury wine estates a few weeks ago.
Yep.
But I think it's even more simple. We're starting to learn that the basic products like bank accounts, insurance, credit cards, changes in diet and other consumption habits are growing at rates far faster than any other economy in the world. As Jamie mentioned, we added Asia in March. It's up about 20% since, and we picked Platinum for that exposure for a few key reasons. One is that they understand Asia. Platinum's, I think they get the nuance. China's been a big part of the Asia. China's been a big part of Platinum's funds for a while. 2 is their track record, as Jamie said. They started Asia Fund in 2003 before pretty much anyone else, and they've been through multiple crises and navigated through that. And 3 is diversification, in that it looks beyond what the index, the huge holdings in the index, and looks at more economically exposed businesses. So it gives us better diversification to the actual on the ground economy. I'll pass back to Jamie to grill Joe.
All right, Joe, here we go. 10 quick fire questions. We're after 1, 2, or 3 word answers, but if you get involved and go a bit longer, that's okay as well.
Okay.
So here we go. What's the best stock you've ever bought?
Well, recently it's Meituan. I mean, we've made money twice this year. The first time 100%, the second time about 400% within 1 year. So that's great.
All right, we might expand on that a bit further. What later in session?
Okay.
What is your biggest investment regret?
Well, shorting in the Asian market when the market was cheap.
Yeah. What is the one red flag for any investment?
Well, when the stock is optically cheap, and I cannot work out why.
There's always a reason, isn't there? Always a reason. What's the most important ratio you use?
Just the PE ratio.
Just PE, yep. Okay. Yeah. Pineapple on pizza?
Yep, the margarita. So no pineapple.
No pineapple. Yeah. What's the best piece of business advice you've ever received?
This is from Care. We'll respect the intelligence of the market.
A good one. Name one belonging from your youth you still wish you had today.
Well, my old Apple II computer. I use the program and play games on. It's great.
It's probably worth a fortune now.
Yeah.
Best investment for Armageddon, USD, Bitcoin, government bonds, or gold?
Yeah, it depends. If we get a big recession, USD and bond. If there's huge money printing, gold, and economic recovery, Bitcoin and commodities, which is what we are seeing now.
Okay. Let's pretend you're retired, Joe, and you only can hold one stock for your whole retirement. What stock would that be? All your money has to be in this stock.
Okay, HDFC Bank in India.
Good one. We'll talk about that a bit later too.
Okay.
You've got, in the next 12 months, you can short one NASDAQ stock or NASDAQ 100 stock. What is it?
Well, it's a bit risky, this one, but Tesla.
Tesla. So many people,
answer, isn't it?
It has slayed everyone that has said that they're going to short. So good luck with that, Joe. Good luck.
You got to be right. The clock, would be right one time. Broken clock is right one time.
All right, we're on to the questions now, Joe. I might kick off. Tell us a bit about you. You've got a different background than normal portfolio managers that we talk to.
Yeah. Okay. Thank you. So I run the Asia Fund and also the Asia Research effort at Platinum. I studied and worked as a medical doctor in Sydney, and so I've worked in hospitals. But what I realized then, about 20 years ago, was that I liked looking at businesses rather than bodies. So I switched and joined Morgan Stanley, and then came to Platinum after that. And I've been at Platinum for 17 years. So initially started as an analyst for Asia, and then basically started running the fund about 6-7 years ago. It's amazing. I mean, it's just amazing, to be able to do this job over the last 17 years, seeing the firsthand the economic development of the region, and I think it will continue. So yeah, that's my background, I guess.
Fascinating. You work with some amazing people. Kerr and Andrew are, some of the best investors that have come out of Australia in the last 50 years. That must be a real honour. Yeah,
it is an honour, and it's actually, I've learned a lot from those guys. I guess the key thing is not even the investment acumen. It's more, the people. I mean, it's actually I guess the humbleness despite the success that they've had.
Does your role change going from analyst to portfolio manager? Has that been a huge change over 17 years, or?
Yeah, look, I mean, it's a long, it's a long-term process. Basically, I started building a proper Asia team in Platinum since about 2009. And so from previously, it was just Andrew, me, and one other person managing the Asia Fund. And since 2009 onwards, I mean, we built a proper team and then managing the portfolio. The good thing about the transition, which makes it easier at Platinum, is that even a PM, I mean, we are actually analysts as well. Our process is very bottom up. In other words, we look at to understand how businesses work, and so that's that skill set gets transferred easily between working as an analyst and the PM. And the PM have other roles as well, such as managing people, managing exposures, have a more top-down view when needed, which helped in the COVID this year for us. So it's interesting skill set that you need to pick up, but the fundamental understanding of the business, which is essential to our process, remains the same.
Yeah, so it's a bit different to almost the CIO structure where you stop researching and start assessing ideas. You're still involved in both.
Yeah. The best bit is the researching of the companies. That's the most fun part of the job, and actually teaching younger and more energetic people how to do it. That's quite fun too.
And Platinum Asia, it's called Platinum Asia. So assume, and it's ex-Japan. So you don't have any Japanese exposure. And the definition of Asia goes all the way over to India. Is that correct?
Yes, so for our purpose, it is actually, basically the big countries are India, China, Southeast Asia, and Korea, but we don't include Japan because we actually have another Japan, Platinum Japan fund that's actually of a longer vintage than us. And also the market's different. So Asia that we're looking at are basically growth economies in most cases. Like Japan is more developed and in fact quite Asian economy. So it's
Very
different sort of.
too, isn't it?
Yeah, it was different style, different I guess opportunity set.
So how many stocks in your portfolio, Joe, and how many stocks out of the realm? How big's the realm? Yeah, the realm is big. I mean, we tend to focus on the mid cap to the big cap, so not the extremely small stocks. The fund that I manage, now is around $6.5 billion Australian already. So we can't liquidity. The small stocks, we simply it would not make any difference to returns. So if we look at market cap of a certain size in the region, it's literally a few thousand of them. And in the portfolio, we have usually 40 to 60 stocks. A big stock would be 5-6%. A small stock would be 1% or so.
And you can take long and short positions. You can take long and short stock-specific positions.
The portfolio has mostly we can. Yeah. We can. And we haven't done a lot of it recently because the market's been cheap. We've taken some short position on the indices in February. So the net investor position for the fund went down to 54%, which is very low, the lowest in history of the fund, I think, because we had an insight that the world's going to close down because of COVID. And at that stage, the market's participants, generally speaking, were quite complacent. So we took the short position, and it helped us to sort of ride through the volatility well.
And you managed to put risk back on in April as well when you started seeing it turn.
Yeah, it's interesting. So I was talking to my mother, who's close in her late 70s. And before the COVID, she didn't know anything about these kind of stuff. Although I studied medicine, I knew what it was about, but she didn't. But then by April, when I talked to her, and she's staying at home, keeping herself safe, and she said, "Well, when are we going to flatten the curve?" And I thought, well, even she knows what flattening the curve actually meant, and I think the market is pricing a lot of the fee in already. So that's just one anecdote. And so we actually basically bought the good companies in the region that's been universally sold off by 30 to 40%. We knew that we would make money eventually, irrespective of the outcome of the pandemic, because it go. I mean, the pandemic will actually go eventually. And we were quite prospective because we thought the market's prospective because of the valuation, and we were confident about the vaccine. We were seeing a lot of economic stimulation globally. So. Yeah, so we were surprised actually, how quickly it rebounded, but we were positioned for it, fortunately.
Now you're based in Sydney, and it's an Asia fund. Do you travel to Asia very often? Is it important to be on the ground there? And has COVID affected what you do if you do travel a bit?
Yeah, so normally our team would, there would be someone on the ground, almost, people visit the place, once every 1 or 2 months. I mean, I tend to go to China, India, and Southeast Asia once a year, and then that, each once a year, and that sort of is quite a heavy schedule, because when we go, it's usually 1 to 2 weeks, and we prepare a lot before we go. So we know that what's going on the ground. Talking to a lot of people when we go there is very targeted, and also it's just not just me. There's other people in the team who go there. So literally, if you come to the office any time in the year, there would be literally a few people in the region. In my team or in the global team. Today, I mean, with COVID, of course, the traveling is difficult, but it's interesting. A member of our team is actually in China right now. He's quarantined, did his quarantine a few weeks ago, and he's visiting companies and stuff. It's more difficult.
Hotels.
Yeah. So we actually own a hotel in our portfolio, and he's living in. He stayed in it. And
there you go.
This is great. Yeah.
So
fundamental research, isn't it?
Yeah, fundamental.
Yeah.
So you've got a number of different regions in Asia. There's probably 18 different regions that all have different economic characteristics and growth characteristics and legislation characteristics. And then you have all these stocks that some across the 18, let's say it's 18 regions. I don't know how many regions there is, and some are individual. So portfolio construction, how does that work? Because you might have a great stock in India, a great stock in Japan, in China, and one in Taiwan. How do you balance all that up and then create this portfolio? Because what we've learned over the years, it's not just the stocks you hold, it's also what weight you hold in those stocks.
Yes. So the portfolio construction is, bottom up. So basically, I guess in a nutshell, what it is the portfolio consists of the best opportunities we can identify in the region in any given point in time. So if we find lots of interesting opportunities in China, we would have from a bottom up perspective. In other words, there are good companies with good growth prospects and the valuation is cheap. We'll have more of them in the portfolio. And as the share price rise and the opportunity gets better recognized, we'll try to look for other opportunities from a bottom-up perspective in the whole region. So the outcome is that in terms of geographic split in the portfolio, it's actually in most cases a result of what ideas we can find in the region, as opposed to someone like me or the CIO going, oh, you need to have 50% in this country or whatever. It's more, well, we have 50% in the country because we can find all these ideas in that particular area, not the other way around.
There's no minimums
so it's dynamic.
or maximums.
No, but I guess if even say if we love India. There's lots of attractively priced businesses that are listed. We would not, for instance, have like 60-70% of the portfolio in one country just for diversification. It's a risk management tool to have a bit of diversification in different countries. So it's all rather subjective from that perspective. But there is an attempt to risk manage by geographic diversification and also industry diversification. We don't want to own all the e-commerce companies in Asia just because even if we like them.
Are there different processes involved, or is there a different research process for an Indian versus a Chinese or a Thai company, or is it just all basic fundamentals?
Yeah, so look, I mean, it is the same investment process. I mean, bottom up, understand, what, whether the business can be bigger. The three key things which is consistent in all the positions is that people invest in Asia because they can see the growth in the region. So we want to have, usually we look long term. When you look long term, the picture actually becomes clearer. In the short-term disruption that may impact the share price, you can actually ignore it, like during COVID at the bottom of it. The long-term, good companies will grow. So long-term, number two is be contrarian. Try to stay away from the crowd. When everyone was fearful at the bottom of the market, well, that's in the price. Let's look at the business and are they good? And the third is just have actionable insights. Trying to see whether there's anything about the industry or the company involved that we actually have some specific insights, which the majority of the market don't. And you have all three. You can have a very big position in these stocks because it usually pay off in a magnificent way when it gets recognized. And if we're right, if we're wrong, then all bets are off.
Are there any countries or companies or sectors you just won't touch in the region that are kind of red flagged?
Not really. There's a lot. Look, I mean, I think there's sometimes when the popular belief that if something is is very troubling or worrisome, there's 2 points. That's actually interesting to have a look anyway. You may not want to invest in it yourselves. The reason why that's the case is because if it's well known that something is horrible, well, that's probably in the price. I mean, for the most of the time, not all the time, and therefore, and the second reason is sort of our process to look where people are not looking and to avoid where the crowd is. So we do look at it, and if there's something interesting, after vigorous bottom-up research, we can put capital to work there.
We use a fund called Munro Funds Management by Nick Griffin, and Nick was on a couple of weeks ago, and he was talking about what has happened between China and the US over the last 2 or 3 years. And one thing that his fund is doing is kind of betting on this concept that a leader set of companies will be established in China versus what is established in the US. So obviously, with Ant Financial coming out and Alibaba, there seems to be a real opportunity for China to build a set of service companies like your Apples and your Googles and your Facebooks. But
Yep.
in terms of China, is that a theme that you see playing out, that the Chinese economy and the Chinese market structure or corporate structure is kind of finding a similar pattern to what the US big tech firms are offering?
It's interesting, I guess. For I think particularly in tech, that's interesting. So for tech, we can talk about the big internet platforms, which is the likes of, I guess, the Alibabas or the Tencent or the JDs of the world, which are Chinese, e-commerce and gaming and social media companies. But there's also in tech, there's also the semiconductor, equipment makers and the semiconductor manufacturers, which the Chinese, which the country actually needs and wants. So they're quite different things. So in this geopolitical strategic competition between the two countries, that there is a desire to be less reliant on the outside, and that's particularly so for the semiconductors. And I think the main reason that is that we've seen what happened to Huawei and all these sanctions that's applied to some of these Chinese semiconductor companies. Basically, it's a serious attempt to put them out of business. I mean, when a company is reliant on, most semiconductor manufacturers would require some components coming from the US. And when they say that the Chinese company cannot use any US parts, and also someone can't even deal with US banks, it is a very serious threat. So that as a result of that, the desire for the Chinese government to actually encourage development of semiconductor industry indigenously, it is very real, because they don't want to be squeezed. And then just like if people say, we're not going to supply oil to China, China would definitely want to find some oil somewhere that they can use. So that is actually where that is. But in terms of the internet platforms, all these Chinese internet platforms are born out of extremely intense competition. It's a free market. I mean, it's actually in a way more capitalistic than some of the developed markets, because this idea of antitrust, this idea of IP protection in early years, maybe not so now. It's not existing, but do all sorts of things to compete with each other. And as the result of that, Alibaba came on top, and there's a lot of newcomers trying to get them as well. I mean, that's quite amazing. Tencent is the same group. So that is actually a result of market competition. And they're doing great things. And in many cases, the application of technology, just looking at them, I mean, it's very, it's actually leading the world. In some cases, what we see Facebook is doing is often what, they've seen what Tencent can achieve in a social media front. Because they've seen the payment, they're copying that.
Yeah.
A lot of
fascinating, isn't it? For the last, I'm 45, so the last 25 years, being an investment advisor, we would talk about globalization and the opportunities some of these large companies provide in that globalization. And it's nearly the next set of themes seems to be, deglobalization. Not sure if that's a real word, but where people are saying, no, we need some of these essential services internally. It seems like the Australians, as Australians, we have to drink a lot more red wine now.
I'm hoping it'll be cheaper.
But let's hope.
I had kind of a segue on that with what's going on politics between Australia and China. Australians have generally relied on investing into ASX companies that are exporting to China to get Asian exposure. Does that kind of increase the importance of investing direct into China and Asia now?
Yeah, look, I mean, I think generally speaking, that's a correct statement. I don't know whether it's because of, the spat that Australia has, the government has with the Chinese government. Clearly, I mean, in the short term, that is a problem. But I'm actually quite optimistic in the long term. countries will learn to live with each other. But the more longer term issue for, I guess, the stocks in Australia is that really it's banks and commodities. Those are the main part of the index. And the fact is, I mean, China has gone past the peak of demand for commodities, I think, in my opinion. And also with the attempt to decarbonize, the demand, the profile of what they demand and where the demand is going to grow going forward will be different. When I started in 2004 at Platinum looking at China, I mean, demand for iron ore, demand for all sorts of commodities was growing like 20%, something like 10-20% a year, every year. The number of properties built in China went from a few million units a year to now about 11 million units every year. But is that going to go to 20 million units? Very unlikely. I mean, car sales went from a few million to now 26 million, much bigger than the US car market, passenger car market. So there's some peaking in demand for these things. But then at the same time, the next growth driver for China is more domestic consumption and then technologies. So they'll keep doing that. So I actually believe that if we've got good products, that the people there in there want, and assuming the Chinese economy continues to grow, especially in consumption, it'll be wanted. I mean, I think, but as long as the short-term problem goes away. So I guess be specific and maybe not so much into the old world commodity sort of thing, but certainly the new world. I mean, it used to be the A2 milk was doing really well in China until there's a change of the channels and structure in Australia, right? So the good stuff I always wanted. I mean, it's like, if someone can produce a good, like Tesla. I mean, they're selling Tesla like there's no tomorrow in China. Although I was telling you I want to short Tesla, but I mean, they're doing well in China.
It's on valuation concerns, not on growth.
Yes.
And what about India? India is something that, Drew and I have always thought that if you're going to play India, you would play it through the private markets, not the public markets. But, India doesn't get a lot of press, doesn't get a lot of conversation in the investment world in Australia. But can you just tell us what's going on in terms of the themes playing out in India and what you really like, what you see in India?
Yeah, look, I mean, India is a very interesting country. I mean, the income level is 1/4 or 1/5 of that of China. I mean, in on average. So the economic growth therefore is faster because the base is so much lower. They're doing a lot of things. I mean, if we look at the World Bank's ranking of the ease of doing business. I mean, they rank all these countries on how easy it is to do business. I mean, I don't know, some listeners or viewers may know that it's notoriously difficult, historically, to start a business, to borrow money in India, just lots of red tape. Red tape equals to self-enrichment in some cases, obviously, but which is not good. But now the ranking has jumped from 130 to about 63rd or something like that in the last 4 years. And that's that's a result of the reforms that the current government has done over the last 4 years or so. So that's getting better. I think the key there is to actually find the good companies that actually has a long runway for growth, and also the valuation. And that's the issue with, I guess, that's where ESG may be important, because there's a bit of differentiation in terms of governance when it comes to these in some of these emerging markets, and different companies have different level, how good they are in governance. The better companies tend to do better. So if you can actually buy a good company with long growth runway, well managed, good governance at a good price, at an attractive price, I think it's highly prospective. And that's why I put HDFC Bank, which is a good private bank in India, as one of the best companies to own in the long run.
Is that wealth management, insurance, normal banking?
Yeah. It is a mix of all these things, but mainly it is just normal conventional banking. India has been traditionally dominated by these old state banks, and they don't provide good service. It's just horrible, and then there's a lot of bad debt all the time. But then there's a group of private banks which has grown up, and basically the private banks are taking 100% of the incremental new loans. The state banks are undercapitalized; they're not growing much at all as a group. Some are, but as a group they're not. So in 10 years' time, I think you'll have 3, maybe 4 or 5 of the private banks becoming. At the moment, they're like 30% of the market. They'll get to like 70, 80% of the market. It'll be reasonably oligopolistic. They're well run. They're very careful about the books. These private banks are early, so they go to the private enterprises and go, look, I mean, do you want to pay your employees into our bank accounts? So that's very sticky money, very sticky, cheap money. Cheap cost of funding, and they can lend it out carefully, only the best customers. So these banks are growing at 20% a year, and HDFC is the best one. They're growing to all sorts of other, wealth management and other businesses as well. So that's only starting, but they'll get bigger in 5-10 years time.
Is there a slight different? Sorry, go Drew. I'm going to change it.
No, yeah, I was kind of as well. I was kind of sticking with the consumption theme, and what are the three fastest growing consumer sectors you see over the next decade? Is it domestic travel? Is it banking and finance? Is it alcohol and protein, as everyone talks about?
Yeah, look, I mean, it is interesting. I mean, they're all going to grow. I mean, which one is going to grow the fastest is difficult. I mean, the thing about looking at Asia is there's actually no shortage of growth, growth themes. Most themes are growing. Even something as boring as beer in places, in all these places they're growing. I mean, they're growing in single digits.
Yeah.
Decent growth in this market would be, in this Asia would be 20% or so. But ultimately, it's some things. I mean, I can say, what things are underpenetrated. What things, because it is in a nascent phase of the development, it can grow very quick. I think financial services in India, as we mentioned, that's early. Not everyone has a bank account yet, so they can do better there. And in the more exciting stuff like grocery retailing, online grocery delivery in China, that's growing like literally 200%. I mean, it's a year from very low base, very competitive though. And there's specific themes like domestic brands in all these countries. Because one thing that people may not appreciate is that when you go to Asia now, I mean, at least going to the more developed in the cities, I mean, they are like any other city in the world. I mean, they're not the Asia of 30 years. So there's if you look at the Gen Zs in these countries, they have not gone through tough times. In fact, they've only grew up in years of prosperity. So as a result, they actually don't mind owning some of the local brands, wearing some of the local brands, as opposed to just always buying foreign brands, as long as the quality is good. So domestic brands, financial services, online grocery, some of the technology companies, and financial, digital payment. I mean, still growing rapidly. Online lending, fintech. It's not that different now. I mean, the growth areas there compared to the rest of the world depends on the country. Some countries are a bit behind than others.
Faster growing than Australia at 2% for most of our sectors. So, sorry, Jamie. Yeah. So, sorry. So the point I guess to make there is actually, I guess a lot of the work is for us is apart from knowing what is going to grow or which industry is going to grow, is really to assess which company can actually deliver the growth in the long run, and what valuation we're paying for that growth. Because lots of companies we claim that they can grow 30% a year, and you look at the consensus numbers, like the brokers estimate, yep, it's doing that, and it's on 25 times, yep, it's reasonable. But because of the competition and the different level of management ability in different companies, some are more likely to deliver that. And the second thing is just the price, the valuation. If it's expensive, we tend to walk away. If we own the company already and it's expensive, we tend to reduce the exposure and look for the newer opportunities.
So let's talk about that. You said your favorite ratio is PE ratio. So to me, it feels like your fund out of the Platinum stable, which has always been a really deep value group or value group, is more growth orientated. So what's the average PE of your portfolio?
Yeah, I mean, I think it is around 25 times. I mean, I got to check this. I think it's around there. Yeah.
Yep. And obviously, because you were in growth companies, if you look at PE forward, it'll drop substantially. I'd say.
Yeah.
So if you're talking about
it is.
Yeah. Okay. Great. We want to. Drew and I were at a conference 3 years ago, and we heard this fabulous guy speak from a really small bank called Ant Financial, and he was the CEO, and we were blown away by the phenomenal growth. Was it 3 years ago or 4 years ago?
I think it's 5 years ago, Jamie. It's been
and he was just talking about.
You had more hair, definitely.
Yeah.
I had less grey hair.
Yeah. Anyway, it was a few years ago, and he stood up, and there was only about 35 of us, 40 of us in a room, and he talked about this phenomenal bank that he created under Alibaba and how many accounts he has and how he was using big data and AI to assess loans, and talked about the old loan process of filling in a form, and basically most people lie on the form and then sending it to an old credit assessor. And we were amazed by that company. Come fast forward 3, 4, 5 years, whatever it might be, and Ant Financial, owned by Alibaba, or I think Alibaba owns 30% of it, is about to be listed at some point in the next 12 months. Is that something? Obviously, you own Alibaba. Is Ant Financial something that you would think about including in your portfolio, Joe?
Yeah, look, I mean, so I think Ant is running into some regulatory problem, but certainly they will get listed at some point in the future. But it is a fantastic company. I mean, we also actually went up to Hangzhou, which is the east coast of China, to visit that company. I think the most recent time was last year sometime. The business hasn't changed. I mean, it's just growing bigger. I mean, I guess from when you guys met the CEO. Yeah, absolutely interesting company. We did not like the valuation because, as I mentioned, we want to be a bit more contrarian in the way we apply the capital. And financial is interesting because I mean the marketing of the IPO when it was going on the market was first rate, and then everyone liked it, and it's a great company. But they raised the IPO price a few times, so at the end we just thought, well. It was going to be 200 billion market cap US, and at the end, when it came to the market, it was about 330 billion at the end of the marketing process.
Wow!
So it's pretty good, amazing stuff, and we like it. But I guess that really highlights a few things, which I touch on what we talked about before, which is these markets are huge. I mean, just China and India alone, the population is close to 3 billion people. I mean, it's not quite half the world, but it's almost there, just two countries. The GDP is going to be huge if they just keep growing for a few years. It'll be the sum. I mean, even China. I mean, these countries alone, bigger in a few years' time would probably be similar to US and Europe combined in terms of GDP, and that's happening in these places, and some of the stuff, as you said, Jamie and Drew, that they're doing, Ant Financial, for instance, amazing, innovative, basically using the payment system like PayPal. Although they're charging nothing, they're charging 20 basis points when people use the thing. PayPal, costs quite a bit, as I'm sure some of us have used it, and they charge you a big commission. And they build this financial services platform, lending, insurance, and what have you on top of the payment system. Because they've got the data, they've got the customer, quite amazing. So it's just the innovation, it's the competition that's driving that. And these things, as I mentioned, I mean, it is actually leading the world in application of this kind of stuff. There's a lot of big data, big AI, artificial intelligence, which they're using to build a business up. A similar business, which is it explains the level of competition and innovation. Maybe I'll talk a little bit about the online grocery delivery as well. Also, online the e-commerce business, because in the developed countries we're used to Amazon, taking over the whole I guess the majority of e-commerce market. In fact, getting rid of the out-competing the brick and mortar stores in most instances. So that has played out in China. So as a result, now if you go to China. The online, the stuff you see online, the same products you see online would have the same price as offline. So you can go to a shop, buy the same, I don't know, umbrella or something. The price of that would be very similar to the price of the e-commerce price. And that's through many years of the rents in the physical property adjusting. It's a retail stores controlling costs so that the cost structure can equalize. But now the interesting thing is the delivery system, the last mile delivery, express delivery system in China is so cost competitive that these offline stores are actually, getting more competitive against online. Yeah. Because the previous problem was online is always cheaper than offline. Let's get it online, right? But now, because the price is the same and the last mile delivery is so quick, so it's actually now what happens there is that it's not uncommon for people to travel domestically in China, to go from Shanghai to Beijing, for instance, and they don't bring anything. In some cases, they would call up this e-commerce company and go, look, I need some toothbrush, I need some hairspray, I need some shaving cream or whatever. And the local delivery network would actually buy it from the local stores and deliver the product to your hotel room within 40 minutes. Because because of the density of the Chinese cities and because of the intelligence, the cost of delivery, like for example, for food delivery, like Uber in China, they've got this Meituan, which we make a lot of money on. It's less than $1 US to deliver per meal because of just the density and just the big data they're using to organize the routes and stuff. So it's just there's always new challenges in China. There's always competitive. It's just very innovative what they're doing.
Okay, stocks, Drew. Do you want to kick that off?
I've got a favorite in here, which you kind of wrote up in your latest quarterly, which is Li Ning, kind of a fast-growing competitor to the likes of Nike. I'm a Miami Heat fan, as I said in the notes before this.
Yes.
So two of their biggest players have been early supporters of Li Ning, sports apparel company. Can you give us kind of background on what they do, how they're growing?
Yeah,
they've been around for a long time, but really coming into their own now.
Yeah. I mean, this is a classic sort of great stock picking by the analysts in the team. So Li Ning is basically, we think, is like the Nike or Adidas of China. As we mentioned before, the youngsters, Generation Zs in China, they've grown up, seeing good times in China. So as a result, they don't necessarily always want to buy the Nike or the Adidas, because previously, people prefer the Nikes because they, in a way, a little bit not as proud, I guess, about the local brands. But the young people are actually more proud because they've actually seen the good times. So Li Ning actually is an he's a person. He's still alive, right? Living, I think, in Hong Kong. And he was the gymnastic champion, Olympic champion from China in the 1980s. So as you can appreciate, 10 years ago, it's a bit staid. I mean, it's not that fashionable to wear someone who's a bit old. The brand is named after this sort of older guy, right? But the interesting thing is when we walk around in China, we saw some of these young people wearing these Li Ning hoodies. And we asked them, so it's very nice. And we looked in the shop. I mean, this thing, just the Li Ning is just sort of like just the word leaning on in front of them. Cost about $200 US, sorry, Australian. And I thought, wow, I mean, that really tells you something is changing. The locals are, at least a proportion of the local youngsters are picking it up. And we did a lot of work into it to realize that, I mean, this brand is actually most likely is becoming an authentic local Chinese brand. The brand is getting revived. If we remember in the old days, there's a period of time that a brand like Adidas was like going nowhere, was getting, was losing popularity. But years ago, it sort of started to revive because some clever products, some clever marketing, and this is what we think Li Ning is doing. It's great that we picked this stock. I mean, it's gone up like 50-60% in 3 months. But we still have, we've trimmed back a bit, to be honest, because it's gone up quite a lot. But we still own the stock. We like it.
What about Taiwan Semiconductor? Is that similar to NVIDIA? What do they do?
Yeah, look, I mean, I guess this is basically it is literally the best advanced semiconductor manufacturer in the world. What they do is they actually is an outsourced manufacturer for semiconductors. So in your Apple iPhone and even NVIDIA chips, and what have you, a lot of the more advanced semiconductors, which goes into the smartphones and iPads and what have you, are manufactured by Taiwan Semiconductor. Because the reason why because they're world leading. And recently, Intel, which most people think is just a world leader in chip manufacturing, even they have to outsource to Taiwan Semiconductor because they have not invested in manufacturing technology as much as Taiwan Semiconductor. And so why has these guys been good? I mean, every year, Taiwan Semiconductor invest in R&D and equipment worth about $20 billion US. So as a result, they're world leading. And I guess the thing is, they're almost a monopoly in the world in producing these things. The only competitor really is Samsung Electronics, which we also own. So I guess this illustrates the point that actually some of these companies in Asia are actually world leaders. I mean, as opposed to, I guess, the idea that a lot of them are just, factories making clothes. I mean, actually, there's a lot of these things happening, which is amazing. I mean, it's amazing to watch.
Yeah. What sort of PE does TSMC or Taiwan trade on?
Yeah, look, I mean, when we bought it, it was in mid to low teens. It's rallied a bit. Actually, we bought it we added to it at the bottom of COVID at 260. Now it's gone to 490. PE ratio is about 23. I mean, it's a fantastic company with a lot of cash on the balance sheet, and despite that, it's making like a 25% ROE. Yeah. Because of the monopoly position that they can charge these prices.
And when you assess that, you said 20 billion in R&D, that would get expensed, so it would increase their PE. Do you account for that as well, or?
Yeah, look, I mean, that gets expensed. I mean, so that's part of the PE. That's why PE is quite interesting, because PE, the earnings would capture, your depreciation, your amortization, and also interest costs. So when we, earnings, if it's properly represented, actually, captures all these things. So that's quite good metrics to use.
Yep. My next one was on to that luxury hotel is a Huazhu, or my pronunciation is probably not great.
It's pretty good. It would be better than mine, Drew.
That's cool. I mean, you're very good Yeah, look, I mean, it is. We think so. So when we go to China now, we almost are forced to stay in this hotel. It's just well run. It's what happens is, I mean, they've got set up. I guess the hotel industry in China is still very fragmented. A lot of mom and pop operators, not the most professional, and as a result, the cost of running it is high. Huazhu is very good in setting up a process to actually enable the mom and pops to actually more or less outsource the management to these guys, and they pay a fee, share a bit of revenue or gross profit with Huazhu. So Huazhu by itself, for the most part, is a very capital light business, because what they do is they sign up these hotels, give them a good way to manage the hotel, give them the IT system, which is very important. These guys have invested in it. Maybe sometimes even provide someone to manage the hotel for these people. The franchisees provide the hotel, the physical hotel, and basically give up a bit of the revenue to this company. So it's an asset-light, fast growth company that's consolidating the fragmented, mom and pop hotel cottage industry in China. Yeah. It's growing rapidly. During the down market, it actually signed up even more customers because people are having tough time, during COVID. So they actually sign them up, and they're growing even faster. When we visit some of the 5-star hotels in the region, as an investor, a lot of them actually tell us that they actually talk to Huazhu to try to learn from them how to manage the IT system in the hotels. And this is literally like first-rate 5-star hotels. They talk to this little, it's not little, but talk to this new company to learn from them how to operate their hotels, which has been existing for like 50 years.
Got numbers around so that'd be benefiting from business travel and kind of leisure travel in China. What are the numbers like in terms of people moving?
Yeah. It's interesting. So in terms of domestic tourism, it's pretty much back to normal. I mean, it's a lot of people, I guess, I don't know whether people believe the numbers, but actually I do. I mean, if I look at the numbers from all these companies, it does suggest that. Domestic travel is back to normal. International is still probably 90% lower, below normal, as because of all the quarantines and lockdowns and what have you. The process of detecting the virus is very stringent, and that's the reason. One of the reasons why we were a bit more positive than I guess the bulk of the market is the work we've done, looking at what the regulators there were doing during the peak of COVID. Basically, when someone is diagnosed there, the 20 other people surrounding that person basically gets isolated. I mean, that's what these countries can do. and so 20 people isolated per one person infected. So there's literally hundreds of thousands of people isolated at one stage. And they publish these numbers every day. People can choose to believe it or not, but just our fundamental bottom-up work, talking to people on the ground, and just seeing how draconian it was, it gave us confidence that, well, they'll manage it. Just like, we're doing very well here now, in terms of managing, not even doing something as draconian. So that's great. So travel can come back as long as people feel confident. If there's an outbreak, yeah, they have a local lockdown again. So domestic travel is back to normal. Tourism spend, however, is still 20% below normal. I guess there's still a bit of reluctance, as you can imagine, but for the most part, it's back to normal.
So Joe, tell us.
Oh, sorry.
Go, Drew.
Well, I've heard Ping An described as it's an insurance company, but described as a tech company.
Yeah. I mean, I can talk about that. I mean, it's Ping An, we've owned that position for a long time, on and off. When it gets expensive, we sell it. When it gets cheaper, we tend to add to it. It's an interesting company. It's a company which has managed to grow more or less uninterrupted for literally 15 years at 20% rate. And then sometimes we get it expensive, it's on 20-something times. When it gets cheap, it gets up to 8 times. So it's a life insurance company and also a lot of fintechs attached to it. And I guess it relates to how some of these private companies in China, they're very innovative. They invest their cash flow into R&D, into investment in technologies. Literally billions. I mean, this company invests billions every year in AI, voice recognition. When you call them, they can basically verify your voice and say, you are who you are. And for the car insurance, which is part of the business, when someone has an accident, for example, the customer has an accident in China, they literally take a picture using their phone or maybe a number of pictures and send it to the headquarters, to Ping An, and the AI actually can detect, what's broken, how much does it cost to repair, high level accuracy, and they actually will have someone to come and actually look at your car because they actually have AI to work out where accidents are likely to happen. So I mean, it is pretty amazing stuff. And so compare that to a boring state company, which they're still existing in China. It's hard to compete against that when there's like real entrepreneurial zeal and creative destruction to the old states. So we tend to focus a lot more on the private companies rather than the state. Well, a few state ones, but not a lot. So it's interesting.
It's like this. It took us a pandemic to start using QR codes in Australia, but I think they've been used in China for like 10, 15, 20 years, haven't they?
Yeah.
Yeah, it is amazing, especially the last 5 years with the payments. I mean, they scan the QR code for payments, and it's just taken off. I mean, it's remarkable. I mean, people, when I was traveling through China, I think this is a few years back, with one of my guys, and he's an English guy actually, and he's in my team. Sorry, he's an Australian guy, but he was English. We tried to buy some. He tried to buy something in the high-speed rail station. The company gave us some 100 RMB notes, tried to pay for it, and the lady at the counter didn't know what to do with it. So he opened the counter, the cashier opened. There's no change.
Yeah.
And she goes, how do I use this? And so the lady behind us, behind him, because I wasn't with him at the stage. When he was checking out, I actually grabbed him. I can help you here. But the lady behind him actually paid for the thing for him, and we felt so bad. So we thought, actually, please take 100 RMB, but she wouldn't have it. So thank you. Would you like some of this then? Some of the chips that we bought.
So Joe, last stock. Tell us a stock we don't know. Tell us something that we'll all know in 10 years about an up-and-coming stock that you're looking at or watching or interesting.
Okay. But there's a few of those, and I'm trying to pick, I guess, what industry we want to focus on. But, we can talk about Kingsoft. I mean, Kingsoft, let's talk about an Indian stock called Interglobe Aviation. So we bought this stock when at the bottom of COVID. It's an airline. It's an airline operator in China, in India. It's the best. Basically, it's best airline in India is a low-cost operator. Low-cost operators are great, I think, in most markets actually. What it is I mean, before COVID, it had about 40% market share in India, and this includes the commercial airlines, includes Air India. So it's not just low-cost market share; this is entire Indian market share.
Yep.
During COVID, the market share, clearly the volume's fallen, but its market share has grown to 60%.
Okay.
So that's interesting. And so it's got a solid balance sheet. It can actually last for a long time, and even if times were not good, it can last. It can grow. It can grow for a very long time. And the Indian market has been it's very nascent. It can grow at 20% a year for a long time. So we think in due course, when the recovery comes in India, which it's steadily improving, with opening up, this stock is very well placed.
It makes perfect sense. So
yes.
First, Joe, on behalf of Wattle Partners, we want to say thank you. You're running a phenomenal fund, near $5 billion. It's been average return over nearly 17 years of close to 15%. Enjoyed the last hour. Thanks for managing our clients' money, and thanks for appearing on this show with Drew and I. Really appreciate it.
Thanks, Jamie. Thanks, Drew, and thanks everyone for watching. It's been a lot of fun, so I appreciate you giving us the opportunity as well.
Hopefully we'll have you back in the new year. We're
Absolutely.
doing a set of thematics, so we'll pick a theme and we'll go deep in that. So.
Okay, no problem. Cheers.
All right, thanks, Joe. Thanks, Drew. For the audience, we're having next week off. The week after, we're doing Outlook for 2021. So please join us on a Wednesday at 10:30. Again, thanks, Drew. Thanks, Joe.
Yeah, cheers. Bye.
See you guys.